It's Friday, 28th of March, and this is your Capital Economics Weekly Briefing.
I'm David Wilder.
Coming up, the latest from our China Activity Proxy, what it's telling you about the Chinese economy that Beijing isn't. But first, Group Chief Economist Neil Shearing joins me fresh off a plane from the US, and Deputy Chief Markets Economist Jonas Goltermann also on the show with us. Hi, Neil. Hi, Jonas.
Hi, David.
Hello, David.
Hope neither of you have been added to any Signal group chats by mistake this past week. Let's kick off with Neil. I wanted to ask you, because we've just had the US PCE spending and inflation data for February. What are the key takeaways?
The key takeaway, I think, is there's a bit of a whiff of stagflation in the numbers, if we're being honest. So a lot of the focus, obviously, on what it means for PCE inflation and in particular core PCE inflation. And on that front, it's pretty bad news for the Fed. So core PCE prices up just under 0.4% month on month in February. That pushes the annual rate back up to 2.8%. And of course, all of this is coming before tariffs. But equally, if you look at the spending side, nominal personal consumption in nominal terms only increased by 0.4%, just over 0.4%. So we're looking at something like flat to 0.1% month-on-month increase in real consumer spending. So, as I say, a bit of a whiff of stagflation. Now, this is not the US economy collapsing. I think some of those kind of recession concerns that we pushed back against at the time, I think they've started to ease. But this does look a bit like consumer spending losing some momentum, and at the same time, inflation pressures starting to build. And as I say, this is all coming before the effect of any tariffs.
Slightly too hot for comfort. Price numbers, slightly unfriendly consumption numbers. You said bad news for the Fed. How does the Fed play this? The last we heard, the FOMC were on the sidelines in no real hurry to act, talking about a climate of elevated uncertainty. This isn't going to tempt them in off the sidelines, is it?
No, I think on the sidelines they will stay. So no changes in Fed funds for the foreseeable future. Obviously, the market's still pricing in 2 or 3 25 basis point cuts to the Fed funds this year. We've suggested that the next move down won't come until 2026. So we don't have the Fed moving at any point in the next 12 months. So on hold this year. So a bit of a difference between us and the markets on that front. These numbers are not strong enough to cause any rate hike concerns. The inflation numbers are not so strong that they would push the Fed to tighten policy. But equally, it takes rate cuts off the table when you have core PCE prices increasing just under 0.4% month on month. And as I say, the effect of tariffs still to come.
Yeah, as you say, potentially now slamming into the side of the economy is another wall of tariffs. I'd say, given the prospect that you've got still hottish inflation combined with the signs of consumers perhaps faltering, you'd think it would give this administration pause. But given this administration, who knows? What's your take on how this is going to go down in the Oval Office?
I don't think for 1 minute that President Trump is looking at the core PCE price numbers for February thinking, oh my goodness me, I need to stop this tariff announcement. Let's roll everything back, because there's more than a whiff of stagflation in some of the more recent economic data. In fact, I think this goes to the heart of something that's going on in the US. You get a sense of going on in Washington, which is some people refer to it as sane washing some of the economic policy program. That is to say, to put an intellectual architecture around what some of the policy moves, and that particularly relates to some of the initiatives and measures that have been mentioned as part of the Mar-a-Lago Accord. Whereas actually, I don't think there's any necessarily intellectual coherence to any of these policies. And I think the justification is pure and simply that one consistent message that Trump has espoused over the past 40 years has been that he thinks tariffs are good. He's the self-declared tariff man, and this is what we're seeing in action. So I don't think 1 or 2 months worth of soft data on the real spending front or hot inflation numbers are going to deter him. I don't think there's an intellectual kind of architecture around this. I think it's just all done on gut and hunch, and he's said this for the last 40 years, and that's what we're seeing put into practice. Now, I guess the question is, where does that leave us with respect to tariffs? We're going to get we've had those announcements on auto tariffs. The administration has flagged, or President Trump has flagged, the potential tariffs on pharmaceuticals and lumber are coming down the track. And of course, we've got the announcement in the coming week on reciprocal tariffs, which started out looking like they might be quite substantial. And subsequently, President Trump has suggested they might be more limited, but frankly, who knows? Now, for what it's worth, we've baked into our forecast an assumption that the average US tariff rate will increase by about 10 percentage points. So from about 2.5% at the start of this year to about 12.5% on average. That's the effective tariff rate. We've already had an increase in the effective tariff rate of something like 6% or so. So we're perhaps up to, rather than that peak of 12.5% that we thought we might get to, we might be at the 7-8% at the moment. So a bit more to go in terms of tariffs, I suspect. Now, if we get tariffs going up to 12.5% on average, that 10 percentage point increase, then that's going to add another 0.7, 0.8% to PCE prices. So you're potentially going from, at the moment, 2.8 to potentially all the way up to kind of 3.5, maybe even close to 4 if tariffs are a bit more aggressive than we've assumed. So we're not yet seeing the effect of tariffs on inflation, but I think it's going to come.
And Liberation Day is still on then for this week. Liberation Day, of course, being what Donald Trump is calling this scheduled 2nd of April reveal of the reciprocal tariffs plan. More data this coming week is the jobs report on Friday, the non-farm payrolls numbers for March. There's lots of noise around tariffs, as we've discussed, lots of noise as well about Elon Musk's war on federal employment. Not much evidence in that February report of the impact of that. So what about this coming Friday's March numbers? Is that the one that's going to capture the fallout from what Doge has been doing?
You're right. There was not much evidence of Doge layoffs in the February employment report, but then we didn't expect there to be. So most of those layoffs came later in the month and outside of the survey window. We will start to capture some of the Doge layoffs in the March employment report, but some of the early signals, if you look at some of the low-level data, suggest they might be perhaps a bit more modest than many have anticipated, maybe in the 25,000 range, something like that. And set against that, we might still see a further bounce back in private sector employment following the weather-related weakness at the start of this year. So all told, we've gone for a 140 increase in non-farm payrolls in March. That incorporates, as I say, 25,000 reduction in federal employment as a result of the Doge cuts. There's probably more Doge cuts to come through. But I think one of the points that's worth keeping in mind is that the labour force is now probably only growing at, say, 80, 90, 100,000 a month and will continue to grow at those rates because of the clampdown on immigration. So we've been through this period in 2023, 2024, where the labour force was growing in some months kind of 200,000, 300,000 or more a month. We're back down to kind of 80, 90,000 a month. So if you get an increase in payrolls of anything north of 100,000, then the unemployment rate is basically going to stay flat or maybe even drop back a little. So because the labour force is growing at a much slower pace, you don't need to see these really stonking increases in payrolls employment to keep the unemployment rate from rising.
You're painting a picture of a very challenging environment for the US economy. And I just wanted to pan out from that and ask you about our global economic outlook, because that was published this past day. And it's the first one of these quarterly reports that captures all of this noise around tariffs, around what's happening in employment and what have you. And what surprises me is what it says about the impact of this trade war, and frankly, how little it seems to be that it's going to affect global growth in our assessment, talking about a couple of tenths of a percent off global growth. So what does this tell us then in terms of how much tariffs, for example, are dominating the news cycle?
Yeah, it's an interesting point. You mentioned at the top that I've just come back from a week of meetings in the US with Paul Ashworth, our Chief US Economist, Liam Peach, our Senior EM Economist. The last time I was in New York was the week after the election in November. Lots of optimism back at that point that tax cuts and a wave of deregulation would usher in this golden period of economic growth in the US. We pushed back a little against that idea at the time and suggested that instead the administration's policies would be slightly stagflationary. So we've got a bit of pushback to that idea. This time around, we're essentially presenting a similar view. The tariffs that we had anticipated, baked into our forecast from the start of Q2, are starting to come in. A lot of the immigration clampdown has happened as we anticipated, and the idea of deficit finance tax cuts has shifted to the back burner as we had expected too. But we picked the same story, and the overwhelming response from clients was that it was a relatively benign picture that we were painting. I think it gives you a sense of how expectations have shifted from this optimism to, oh my God, tariffs are going on. Some of the data is softening. the economy is spiraling into recession. And I think the truth's somewhere in the middle. So when it comes to the US, we've got a soft start to the year, followed by a rebound in Q2, and then growth settling at the kind of low ones Q on Q annualized in the second half of this year. In the case of the Eurozone, we've had that announcement on fiscal policy from Germany, but we don't think that's going to do much to boost German economic growth until 2026. And when it does, it's to be a bit weaker than many now seem to anticipate and not replicated in other Eurozone economies. Bit of a pickup in Germany, but not a very substantial pickup in the wider European economy. And then in China, some fiscal support given a bit of a boost to growth over Q2 and Q3 of this year, but those structural problems that we've discussed many times before still very much a drag on the economy. And so growth slowing towards the back end of this year and maybe back down to the kind of mid to late threes by Q4 year on year. Put all that together, what does it give you in terms of global economic growth? Again, it slightly depends on whether your glass is half full or half empty. So if you put all that together, you've got growth this year and next of about 3% a year in global GDP in each year. Now, that's not a disaster, but it's a bit weaker than the average that we've had since 2015. So average since 2015 is about 3.5%. We're looking at 3%. So bit softer, but not a disaster, certainly not a global recession. As I say, it depends a little bit on whether your glass is half full or half empty and what your expectations are. If you expect the global economy to be spiraling into this global trade war and downturn and recession, then I don't think that's likely to materialize. If you're expecting a golden era of growth driven by tax cuts and deregulation in the US and fiscal stimulus in Europe, equally, I don't think that's going to happen either.
Jonas, I think it's probably a good time to bring you in because given all that Neil said, I think one of the most visible signs of the impact of the Trump administration and its policy rollout is what's happening in equities, in global equities, in US equities. We are speaking at just before 2:30 London time on a Friday. That's 10:30 New York. As we're recording it, the S&P's down just over 1%. Pretty rough year for the S&P so far, certainly relative to the last few years. At the same time, we've seen this relatively big rise in European stocks and Chinese stocks coming back. And this all kind of feeds into this stream of work that your team has been working on relative equities performance. With the macroeconomic context that Neil's just given us, what is the current state of US exceptionalism?
Well, thank you, David. That's a good question. I think the short answer is, well, not great, or at least not nearly as good as even a couple of months ago. Though you've got to bear in mind that is, as Neil was mentioning, that's a very high bar indeed. Going into the year, there was a sense that the US was just going to keep rolling, strong economy, strong stock market, building on the last couple of years, plus decade plus at this point of outperformance, really. And the rest of the world just couldn't keep up. And then on top of that, Trump administration coming in, more tax cuts, deregulation, boosting the US economy, and tariffs that might hurt the rest of the world. It was a pretty remarkable period, that November through January. There's a shift in favor of the US, whether that was the stock market, relative performance there, higher US yields, stronger dollar. Investors were treating it like almost as if it was the second coming of Ronald Reagan. Now, the tone has shifted very quickly and very dramatically. You've got questions around the economy, the stock market, the dollar, the whole narrative. It's really up in the air. And some of that, maybe a lot of it, and certainly in the headlines, is policy driven, as Neil mentioned. The past couple of months have been a bit of a shock to the system, it's fair to say. Whatever this is, it sure doesn't look or feel like the second coming of Reagan. Obviously, still early days for the Trump administration, the second one. But so far, they're getting a lot more of the bad stuff that markets don't like, tariffs and so on, and a much less emphasis on the good stuff like tax cuts. Partly because those things take more time to materialize. You've got to go through Congress. You can't just sign one of those executive orders. And on top of that, maybe the economy is slowing or stagnating, even, as Neil was saying, even before the policy impact is really coming through. And so that is certainly a big part of the shift in the stock market. But the other one is what's happened with the AI or big tech dominance and the whole narrative around that, which has been really the main driver of US equity market outperformance over the past couple of years. And again, really going back more than a decade at this point. And that whole narrative is coming under scrutiny for a number of reasons, whether that's China competing now with AI, more broadly the sense that AI, there's a commodification going on, which is a good thing if you want AI to boost productivity and be widely adopted in the economy, but it's certainly not a good thing if you have a stake in the profitability of AI, as these big tech companies do, because commodification means margins narrow and profits maybe don't become quite as spectacular as hoped for. Now, we've written a lot about the AI bubble. We were early to call it more than 2 years ago, or around 2 years ago now. And we've written about the parallels to past bubbles, especially to the dot-com era, which is kind of the obvious link. I guess one way to think about a bubble is that it is a sort of willing suspension of disbelief, almost. Valuations, earnings expectations can de-anchor from the normal constraints, if you will. And it's very hard to say ahead of time what will cause that to end or when that will happen. And it's certainly too soon to say now that this is definitely the end or the beginning of the end. But it does feel like a risk that has risen quite significantly, one that we're increasingly worried about.
But it's a story of relative performance, as you say. And I mentioned just before about what we've seen happening in European equities and in Chinese equities and markets elsewhere. But let's just focus on Europe, because that has been quite a dramatic recovery there, and a recovery in perceptions as well about the outlook for European macro and markets. What we're seeing, though, is it just a reset, perhaps, that maybe the US was overvalued, as you talked about, maybe Europe was undervalued, and so it's just a sort of allocation adjustment? Or what we've seen, is there something more fundamental happening in terms of European equities?
Yeah, so as you say, Europe and maybe Asia as well to a lesser degree. That's the other side of the exceptionalism coin. And there has been some very important good news there, especially in Europe with the German fiscal shift, which that is a very big deal. And you've seen fiscal stimulus in China as well, not on the same scale, and that was largely already expected, but at least they're doing something. And if you think about the tech side of the stock market, China has a much bigger tech sector than Europe, and that seems to have turned the corner to some degree. They're showing the ability to compete with the US on AI, and perhaps more importantly, given that it's China, the government has changed its stance around the tech sector. But as you say, there's a sense that Europe and Asia are, if not undervalued in an absolute sense, I don't think that's quite right. Price earnings ratios, maybe in Asia, they're a bit lower than average. In Europe, they're in line with the long-term average. But they're definitely underallocated in many portfolios because of this decade plus of US outperformance and ever more capital flows going into the US. And from a valuation point of view, the US is, whichever way you cut it, very high valuation is very expensive, and the dollar is also expensive. So Europe and Asia look, on a relative basis, not an absolute one, they look less expensive. So there's a potential for a continued both the valuation compression between the US and the rest of the world, whether that's downward pressure on the US valuations, or hopefully the main factor going forward will be a continued positive reassessment in Europe and elsewhere. And so potential for there to be this sort of turning point, if you will, in capital flows being not so much out of the US, but maybe becoming more balanced.
Would it be notable that these markets can continue to make gains while the US is doing badly? I mean, it's quite an unusual state of affairs, isn't it? Usually you associate bad news for US risk assets as being bad news for the rest of the world.
Yeah, that's usually the case. It's very unusual what we've seen at the extent of the relative performance. It is very unusual. You've got to remember, if you look at narrow down to the period in which US stocks were going down, we had the 10% correction from mid-February to mid-March. The rest of the world was also down, just a lot less, a couple of percent versus 10% plus in the US. And I think that it's certainly plausible that the rest of the world will outperform US equities, whether that's in context of stock markets generally going up, or whether there's more of a deeper slump in share prices. Relative valuations is certainly a big part of that argument, and the broader potential unwind of US exceptionalism. But if you see a sustained weakness in the US stock market, whether that's on account of the AI bubble fizzling out, or because there is a recession or anything else, other stock markets will probably also fall. If you look at the past 30 years, there's no instance of a 10% plus fall in the US stock market in which non-US stocks in the aggregate rise. Most of the time they fall by more than the US. Some of the time they held up a bit better. But you've not seen a case where a major fall in the US isn't also accompanied by a fall elsewhere. Maybe some individual smaller markets could hold up, but it's hard to see it happening in the aggregate.
But these are unusual times. Another thing that keeps popping up in your recent work is the sort of the signaling around the fact that US equities are coming off at the same time that the dollar is weakening. And this is also quite an unusual state of affairs, right? What are these signals telling us?
Yeah, that is actually even more unusual. And to me, that's one of the biggest red flags that we're seeing now. Because typically, as you say, stock market's down means the dollar goes up because the dollar in the US is a safe haven on the global economy, or even just the US economy falters. And the pattern that we've seen recently with stocks going down, dollar going down at the same time, it's only occurred a handful of occasions over recent decades. It was briefly in the spring of 2023 is the last time that sort of mini banking crisis. There was a longer similar period in 2007 at the start of what became the global financial crisis, but initially that was seen as mainly a US problem. Both of those are examples of financial sector instability in the US specifically, and that's why the dollar and stocks are going down at the same time. Two other periods of this pattern are in the middle of 2011, and that was if you remember, the first US debt ceiling standoff, the S&P ratings downgrade, and also in 2002, 2003, around the end of the dot-com bubble and that downturn. None of these obviously are a particularly direct analogy to what's happening now, but I guess you could say there's some similarity to those last two. You think about concerns around the US fiscal situations. They're not really dominating the headlines. They are there as an underlying issue. The precarious US fiscal position is maybe part of the underlying discomfort with how sustainable this US exceptionalism really is. You might think of it as being the potential Achilles heel of the whole situation. And as I mentioned, the uncertainty of the tech sector, obviously, that there's some similarity there as well. And if you take a step back, both the dollar and the US stock market, they're very highly valued. If you compare it to the past, the dollar in our assessments maybe 10 to 15% overvalued, even after its recent fall, if you compare it to a long-term real trade-weighted average. And the stock market is, I think, still around a 22, probably more like 22 than a 23 forward price earnings multiple. When the long-term average there it's in the mid-teens. So if you put it in that context, if you look down, it's a very long way down, which if you're top in the world, that's how it tends to be. That's a long way down.
Jonas Goltermann there on the long way down for US stock market valuations. And you also heard from Neil Shearing on the macro fallout from the Trump policy agenda, on the global economic outlook, and more. Lots to chew over there and lots more to come in the week ahead. As I mentioned, April 2nd, that's meant to be the big tariffs reveal. We've also got payrolls, there's PMIs, there's European inflation data, and more key releases coming in the midst of all that. On exceptionalism, I'll add recent analysis by Hubert de Barrochet from our markets team to the podcast notes, along with a link to that global economic outlook that Neil discussed. On tariffs, we will be doing drop-ins. Those are our short-form online briefings on Thursday, 3rd of April. Invites to those going imminently, but do check your inboxes during the week for invites to emergency briefings depending on the news cycle. And don't forget our trade war dashboard, which gives CE Essential and Advanced clients the key charts on who's vulnerable to tariffs, how governments are responding, and much more, as well as underlying data to download and plug into your workflows. Now, the latest read of our China Activity Proxy, or CAP, was published this past week. This is our proprietary measure of Chinese economic activity. It's created independently of official GDP data because of well-documented problems with those. And for nearly 2 decades, it's been giving capital economic clients the clearest take in the market of what's really happening in the Chinese economy. Leah Fahy from our China team led the latest refresh, and I asked her what the January-February read signaled about how Chinese economic growth is holding up.
Together our count for January and February, and we averaged across those 2 months to iron out any sort of Chinese New Year seasonality. I think it's really interesting because our reading for the start of the year shows quite a substantial slowdown. So that's down from around 4.2% in December of last year to around 3.3% averaging between January and February. In contrast to official data, so official GDP data is quarterly, so we don't really have a read for Q1 yet. But the activity data that came out earlier this month painted a much more mixed picture, I'd say. So we had retail sales picking up, but services production overall kind of slowing down. And it was quite difficult to figure out what to read into that, really, whether it was a sign of a broader slowdown or not. But I think this data that we've gotten from the CAP has corroborated that the economy did indeed slow down at the start of the year.
You just touched on that. Break it down for us a bit more. When we're looking at the CAP's sectoral readings, what do we see driving this weakness?
Yeah, so it's interesting because it's pretty much entirely driven by a sharp slowdown in the services sector. So we break down our CAP into services sector activity, industrial activity, and construction activity. Yeah, and so in January and February, the slowdown was entirely the services sector. I think the key driver of that seems to be a slowdown in fiscal support. So we had fiscal expenditure growing at 10% year on year at the end of last year, down to closer to 2% over the first 2 months of the year. And that had clearly been helping to support the services sector last year. And that's the pullback of that support seems to have been the main driver of this slowdown.
Is that then the slowdown in fiscal spending? Is that going to set the tone for 2025? How do you see that evolving?
Yeah, so we had the budget for 2025 out earlier this month, and that actually implied a significant widening of the fiscal deficit. So quite a big uptick in fiscal support this year. Obviously, that hasn't come through yet, but we have had comments from the finance minister urging for faster issuance of government bonds and the spending of those proceeds. So we do expect quite a ramp up in fiscal spending over the rest of the year, actually. So we should see slightly stronger growth during the rest of the year, but I would say we still do expect a slowdown over the year as a whole. But obviously 3.3% is quite weak. And yeah, I guess this uptick in fiscal support should help offset some of that soon.
There's lots of questions as well, aren't there, about what's happening on the consumer side of things. We had this special action plan unveiled earlier this month, turned out to lack teeth. But can we expect more concrete measures, I guess money in other words, to drive consumption?
Yeah, so as you said, it feels like the government and the leadership has been paying a lot of lip service, at least, to the importance of boosting consumption, particularly through kind of demand side measures. The follow through has been lacking, to say the least. The only concrete measures we've gotten so far is plans to double the consumer goods trade-in scheme this year. So that will help provide a bit of a boost to consumer spending for sure. Other measures that have been announced, we're not as convinced about. There's going to be an expansion of social security spending, but it's broadly in line with the uptakes we've seen in previous years. So that's not too much to write home about. To be honest, it's definitely something that we're going to have to wait and see about. Again, all the noises are in the right direction, but the amount of money that's actually been put aside clearly for any sort of consumption boosting measures doesn't really signal much of a shift in the proportion of government spending that's going towards consumption this year. Yeah, I guess all in all, there is a pickup in fiscal spending that will support consumers to a certain extent, but I'd say we don't really think the government is doing enough on that front still.
Okay, and I can't let you go without asking about the Trump trade agenda. Obviously, export's been a big driver of Chinese growth over the past few years, but we're potentially days away from this announcement from the White House about a reciprocal tariffs plan, Liberation Day. How does the Trump trade agenda shape China's economic narrative in 2025?
Yeah, so Trump has already ramped up tariffs on China quite substantially since taking office. And we actually think there's quite a lot farther for those to go. We're expecting tariffs to reach up to 60% on China, which is quite substantial. In comparison to a lot of other countries, the share of China's GDP that's actually dependent on US demand is quite small, under 3%. So the direct hit to China's GDP will be relatively limited, but obviously something like a 60% tariff will have a substantial hit. We're expecting that if tariffs do go that high, the PBOC will allow a significant depreciation of the renminbi to offset some of the impact. So based on all these assumptions, we think the hit to China's GDP will be in the region of 0.4%. That said, there is obviously the chance that the PBOC doesn't allow the renminbi to depreciate. And more broadly, I guess exports have been the key driver of China's growth in recent years. I think exports accounted for about 40% of China's GDP growth last year, and mounting tariffs definitely mean that's a tailwind that will fade quite significantly. So we're likely to see exports going from this key driver of growth to something that's dragging on the economy this year.
That was Leah Fahy on China's challenging 2025. I will link to Leah's analysis and to the CAP dashboard. It's available for CE Essential and Advanced clients to explore and access underlying data. But that's it for this week. We will be back after Liberation Day when the Trump administration has made its big tariff reveal. By then, who knows, we may even have a bit more clarity. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.